hearty welcome to Grandma's Wealth Wisdom with your hospitable hosts, Brandon and Amanda Neely. This is the only podcast for strategies to grow your wealth simply and sustainably, like Grandma used to. Without further ado, here are your hosts.
Hi, I'm your host, Amanda, and welcome to Grandma's Wealth Wisdom, where we help you build wealth Grandma would be proud of.
And I'm your other host, Brandon, and this is the third in a series of episodes about FIRE, financial independence, retire early, not about bonfires or that kind of thing. But today, we're going to be spilling the coals, using a FIRE reference, going back and forth, about FIRE's perfect match. Again, financial independence, retire early, and the match to light that fire.
Yep, we love puns here. A couple of reminders before we light the match. First reminder, in the original book, Your Money or Your Life, for step 9, Joe, one of the authors, suggests using bonds as your savings vehicle for your FIRE strategy. He's using a highly conservative approach. And in the updated 2018 version, they expand the criteria for investing to include very conservative and balanced use of mutual funds, real estate, and other investment vehicles. But originally, the concept is using bonds. The second reminder is that the goal of FIRE is to save up enough or have a business like rental properties with enough passive income or regular income coming in that you can live on just the growth of your big pile of money each year, or live off just the amount coming in through your passive income, and never or hardly ever touch the principal of your investment, or in the case of like rental properties, never sell those properties, and that you're able to do that indefinitely. Third reminder, in the last episode, we listed a whole bunch of fire extinguishers, things that could squelch your potential to be able to fire. So you want to avoid those fire extinguishers. They could jeopardize your nest egg or your ability to meet your expenses. And the list of extinguishers that we went through, they're going to apply even if you don't subscribe to the FIRE movement. Even if you want to retire someday, these fire extinguishers are things that could still jeopardize your ability to do that.
And there are a lot of fire extinguishers out there. So go back to the last episode to check those out to make sure that as you're building your wealth or your financial independence, that you don't have those extinguishers that could jeopardize that.
Yep. And then the final reminder is that this perfect match that we're going to be talking about today was a tool that half of all Americans were using back in Grandma's day. Half.
Hence Grandma's Wealth Wisdom.
Right. It was the rock-solid foundation of Grandma's financial strategy and allowed her to rest easy knowing that she had a reliable plan.
So in this episode, we're going to discuss the perfect match for FIRE. First, we'll be going through the attributes of this match that can make it catch fire. Then we'll tell you what this asset class actually is. Now keep an open mind and stick with us. Here we go with the attributes. You have access to the funds to use without penalty. That's huge.
So if you are saving up in various other kinds of investment vehicles like we talked about in the last episode, there could be penalties if you say access your money before you're 59 and a half years old, those kind of things. With this financial tool, you can access the money without those kind of penalties. We actually have done this ourselves. We've been using this tool for about 5 years now. We access the funds to pay off our student loans. We also accessed the funds when all of a sudden we had a flood in our business and we needed, we were closed for a while, then we were getting back up and running, and we needed to pay our personal bills, even though no money was coming in from the business. And so we were able to access that and pay for our rent, for groceries, all those kind of things. Can you imagine the double whammy of going through an emergency like that? And then on top of that, getting something like a 10% penalty because you needed your money because of something happening like that.
That would suck. Having a flood sucked, but...
Yeah. Huge benefit to be able to have access to these funds without penalty.
Second attribute is compound annual growth including guarantees.
Yeah, with this financial asset, there are no ups and downs. There's just steady growth year after year, nice and consistent, almost boring, but not boring because you're
It's consistently moving up.
Yeah, exactly. And, it's not like Brandon and I are guaranteeing anything with these kinds of things. There's actually companies that are over 100 years old that issue guarantees behind this financial vehicle. And that guarantee is as good as the company behind it. So if you find the right company, the best companies, that guarantee is pretty solid and that you can be confident in your own future.
This attribute pays taxes now so that you can use tax-free money in the future.
Yeah, this is a good attribute of this asset class that, when it's properly structured and executed, you do not have to worry about taxes going up in the future. You've already done your patriotic duty, you've paid your taxes, and it frankly doesn't become a concern if you're, again, executing it properly and if it's properly structured as well.
There are hedges against inflation with this as well.
Yeah. So we talked about, the price of a gallon of milk going up, price of a gallon of gas going up, things like that. With this asset class or with this financial tool, there are built-in protections for when inflation is high.
And another cool thing is the fees are front-loaded in the front, of course.
Yeah. So with mutual funds, other kinds of asset classes, your fees go up as you accumulate more cash. Like if you have a 1% assets under management fee, it will be higher if you have $1 million than if you just have $10,000. With this asset class, the fees are front loaded, which means the growth is more and more efficient each year. It gets better with time.
That's really cool. This also has coverage if you get a chronic or terminal illness.
In other words, if you get cancer or dementia or something like that, benefits are included to help you cover the cost.
I don't know what Roth or any of that, if that would do that.
Right.
I don't think. So that's a cool thing. You can, and this I really like, take money out for the major expenses, then you can pay it back to restock. So you can use this money and then pay it back to restock your retirement, right? So basically you're able to recycle money over and over again, which is confusing, right? So you may have to explain that one to me.
Not only, we've talked about having access to the funds and being able to use it before, the key about this part of it is that you are in control of your cash. Not only can you take it out and buy that car, but you can pay it back on your own schedule. Maybe you want to make monthly payments just like you would to, a normal car loan. Or maybe you want to just wait for a little while and pay it back all at once when you get an influx of cash. Isn't going to be any kind of bank charging you late fees or coming to repossess your car if you miss a few payments or anything like that. You are in control, not just of taking the money out and, not having penalties that way, but in terms of how you put it back and how you restock it and recycle it over time as well.
Grandma always said, eat your vegetables. She loved making home-cooked meals with healthy food and from-scratch desserts. Would you create a diet of fast food or cookie-cutter financial products that made you fat and bloated with fees? Or would you like wholesome, time-honored wealth strategies served with balance and trust? Get started with your healthy money planning by downloading Wholesome Wealth Recipes. Your Moolah cookbook is waiting for you at grandmaswealth.com.
And the last one is the most unbelievable in my opinion, but it's true because, again, we've experienced it ourselves as clients. So you remember you've taken money out, but your cash continues to grow even while you take out a loan using the funds as collateral.
Yep. As Brandon said, we've seen this in our own account. We use the funds to pay off our student loans, to get through that flood in our business. Yet we still saw the same growth that we expected had we not touched the money one bit. That's pretty cool if you ask me.
Yeah. So we were able to take care of some of that debt and see our net worth grow up at the same time.
Mm-hmm.
So, what is this thing that has all these attributes? Now, keep an open mind here. If you choose to unsubscribe and delete this podcast because you already think you know, that's between you and your wallet. We simply invite you to listen and consider. We ask that you at least keep an open mind for the few minutes we have left in the episode. Chances are, if you've considered FIRE, remember financial independence to retire early, you're already open to alternatives to the mainstream financial advice out there. Perhaps because you've seen how the mainstream financial advice has turned out for your parents, or maybe even yourself. Now, this is one of those alternatives.
Yeah, so this thing that we've been talking about, this asset class, is called, ready for this?
I'm ready. Drum roll.
Here we go. High cash value, dividend paying, whole life insurance with one of only select companies with the mutual, non-direct recognition structure and financial strength to back up these types of plans.
Now, Amanda, that's a huge mouthful, which is why I think various people have come up with a few nicknames for these types of policies, and maybe you've heard of them. There's the infinite banking idea. There's cash flow insurance. There's a lot of other ones, but our favorite is bank on yourself.
Now, listener, you should totally know that Bank on Yourself is a registered trademark, and we're sharing it now with permission of the trademark owner. Yet, the information in this podcast and all of our episodes on this podcast represent Brandon and our own opinions, and not the opinions of Bank on Yourself or Pamela Yellen, the lady who coined the term, the very nice lady that we respect and admire. But these are our opinions, not her opinions or Bank on Yourself's opinions.
Yeah, we always have to, you want to say those kind of things because, the world we live in.
Well, and it's important.
It's important. And we want to be upfront and really be so that you as person that listens, or if you were to become a client, that you are 100% knowing the things that we do and what we're about.
Yep.
So we could talk for days about how these types of policies work. But here are the top 4 things that you need to know about them.
Yeah, we could list like top 10 things, top 20 things, whatever. We thought we'll start with the top 4. So here we go. The number one thing you need to know is that this is not the kind of life insurance people like Susie Orman and Dave Ramsey love to hate. This is categorically different. This kind of whole life insurance is very different than the kind of whole life insurance they talk about.
And again, we speak from experience because it really affected and helped us. The other thing is options are added to supercharge the growth of the policy so that you can use funds during your lifetime and still, at the same time, leave a legacy for future generations.
Yeah, that's a nice, number 2 most important thing to know is that it has both a within your lifetime and an after your lifetime impact. The third thing is that for those who set up these kinds of policies for others, like Brandon and me, our commissions are slashed 50 to 70% compared with what your typical life insurance salesman would get. And even more compared with someone who does a 1% asset under management fee. In other words, we're not doing this for the money.
Yeah, we actually got into this to impact the future of our clients. We got into this because we wanted to change the world. We saw that there's poverty increasing amongst seniors, and we wanted to do something about it. It wasn't so much about the income that we wanted to make.
Right. And help seniors, yes, but also help those our age that we're not in the same place when we're seniors.
Or people that are, eventually they're going to get there. Maybe they could start early and think through early. And if we can help them make a better decisions, that would be awesome.
Now, number 4, most important thing for people to know.
Yeah, the most important thing for FIRE enthusiasts is that the life insurance company is using, among other things, top-rated corporate bonds to grow your money, and they often are able to hold them all the way to maturity so they can maximize the growth of those funds.
Yeah, they often hold them all the way to maturity so they can maximize the growth of those bond funds. What does this mean practically? So if you were to go out and buy bonds just on your own, like in the book, Your Money or Your Life, what they suggest as step 9, when you buy those bonds, your money gets locked up. You get interest payments during the term of the bond, but you can't use the original price you paid for the bond unless you sell it. With the life insurance company, they have these huge reserves of money, and they can buy bonds and then hold those bonds all the way to maturity when the interest and the original price are paid in full. Meanwhile, as a policyholder, you get access to a portion of the original premium that you sent in to the life insurance company. You can also access the growth of your policy. You can actually use up to 90% of your cash value for anything that you want and still get the growth on the full amount.
That's amazing.
That's totally amazing. That doesn't happen if you just go and buy bonds on your own. And then the other thing that this practically means is that you've shifted the risk from you and onto the life insurance company. I mean, the definition of insurance is the transfer of risk. And when you purchase bonds, there's still some risk. There's less risk than stocks, but there is a chance that you could lose your original amount. When you work with a life insurance company with the financial strength to back up their contracts, you have transferred the risk to them. Plus, there are extra safeguards in place in the unlikely event that the insurance company is unable to meet their obligations.
So, Amanda, we're starting to get into the weeds here with all the details.
Right. We should probably back up for a second. So, we could talk about this for ages. Like I said, we could have like 25 things you should know, but we wanted to share the 4 most important ones today. And if I were to add a 5th, I would simply say the 5th most important thing is to be very careful who you have set one of these policies up for you. It's something that takes a lot of training, and you want to make sure there's accountability for the person you work with too. For us, Brandon and me, we are both Bank on Yourself authorized advisors, which means that we've been trained and we have accountability for how we design these types of plans for people. But even if you don't work with us, still be really careful. You can actually go to bankonyourself.com and you can find a Bank on Yourself authorized advisor through their website. But if you would like to work with us and see how this type of plan might work for you and for your family, that sort of thing for, within your lifetime and for future generations, like all of that big picture, and you want to do that with one of us, all you have to do is go to grandmaswealthwisdom.com and click request a meeting. That's it. You just go there, request the meeting. We'll start the conversation. We see ourselves as educators, not salespeople. So we try to take good care of you. It's an educational process. We're not trying to sell you anything. Really just be there with you and show you what this really looks like for you.
Now, remember, we're only talking about this strategy and helping others see if it could work for them because it, again, helped us so much. These types of policies have literally changed our financial picture and given us a ton of financial intelligence, integrity, and independence.
And speaking of why we're only talking about this strategy because it helped us so much and about our personal story with money, in the next episode, we're going to get into Brandon's history with money. I'm actually going to interview him, ask him questions. What was money like growing up? Those kind of things. And if you join us next time, you can find out why Brandon would eat cereal for dinner back when he was just a bachelor.
Probably because it was easy, maybe. I don't know. That's one thing. And there's other reasons.
We're going to get deep into that.
So don't forget to hit the subscribe button so that you get the next episode automatically.
Automagically.
Yeah, there you go.
And we, of course, invite you to leave a rating and review wherever you're listening to this episode.
So until next time, keep building your wealth simply and sustainably for your own future and the future of our grandchildren's generation. The topics presented in this podcast are for general information only and not for the purpose of providing legal, accounting, or investment advice. On such matters, please consult a professional who knows your specific situation.
This is thepodcastfactory.com.